Hello, is everyone there? Struggling to find the chat. Where's the chat? Hello, people. Can you hear me today? Are we live? Is there a big delay? Is there anybody there? I'm supposed to be live, but I'm not sure if you can see me. I don't- Hello, Alpha Capital community. Is anyone out there? I can see people are supposedly there. Excellent, excellent. Hello, Bletchley. How you doing? Are you winning this week? So I mentioned yesterday. Hello, Tassos Dion. At some point during this, I do want to just go over the DAO setup, merely from an Elliott Wave way of things that I look at, just to say why that was very influential as to why we're always going to break out and hit new highs. Just to show you what the bears, where the bears were, and how it was set up wrong, and how they're now just trying to cheat. So we'll look at that in a short one. Also, have a quick look at the data from the week. I'll answer any questions as we go along. Little look at the CME tool at some point. I want to show you Atlanta GDP now, which I've mentioned a few times during the week and over the past few weeks. Not a lot of people look at it, but it's quite interesting. That's kind of real time construction by the Atlanta Fed of GDP, and they adjust it for all the elements of the economy. So if you all you guys that are obviously interested in fundamentals, it's a really good starting point to see how things react as the data points go along because they update it in real time. We'll have a quick dive into that because I think it's quite interesting, and then we'll have a look at a few charts, etc., etc. So, um, GU long to consolidation range high. Yeah, I mean, I think where are we? Ba-dum, ba-dum, ba-dum. I still think we're grinding up on the EU situation. The dollar is having a short term blip up, as we mentioned. We were expecting at the start of the week. Let me just find that chart. So remember, I said one more Turndale boy, we would sell off. A couple of the guys tried to play it into that data, and then I said we'd have one more bounce back as a wave two. At the moment, the best case scenario before it starts selling off would be equal legs, so up to just around 105. Could extend just beyond that, and then expect the dollar to probably weaken again. I mentioned yesterday there's a lot of chatter starting to come um, about next year, even if they don't move the rates, which it looks like there's a chance they may start doing. Next year, there will be that backed up sequential set of rates. Only a few people are talking about it. I don't think we're gonna have this re-inflation just yet. It'll probably be after they've reignited things, if we get that flow through. So it should still be in this, and I think the EU is the opposite of that. GU haven't really been looking at that. We'll have a look at that one later on, but it still has that kind of dollar weakness element to it, although the UK are gonna go early. I'll have a look at the setup in that in a short while. Um, any other things to add to the list for later on? Right then, so what I'll do is I'll dive into the whole Dow Jones thing just to show you how I look at things, which might be interesting. So for weeks, I've talked about, um, the setup in indices, this whole 3, 4, 5 heaven, and this here is kind of a complicated way of showing you, but it should be quite simple once we've set up. So I'll look at this in the short term. So the reason why, um, I thought the market was gonna extend to what is this, wave 3 top here and beyond was because it's a fundamental setup in Elliott wave. So if you're in an impulsive situation, it's 5 waves in general. You have a 1, consolidation, and you have the daddy boy. The 3rd one is normally the biggest, consolidation, and then a 5th wave. So in that, the one wave that can't be the shortest is the middle one, otherwise it's invalid and it's gonna be something else. Any of the, yeah, we'll look at, crude later. Thank you, Tassos. So any of these waves could subdivide. It's a kind of fractal way of looking at things, which means waves within waves within waves. That's why I talk about high degrees. Or so if the middle wave starts showing strange things, then you know that it's likely to extend, and that's the sort of setup we had. What you tend to have is, um, in the biggest impulsive wave and in the 3rd wave all the time, you can't get the 4th wave overlapping with the 1st. So when you start seeing overlapping, you're automatically thinking that you're in a 1st or a 5th wave because they can be leading diagonals and ending diagonals. So, hopefully that's clear, the basic Elliott wave setup. You might have seen it before. Please ask questions, and I will do a series on it. But the way that we were set up from the October 22 big cycle low, so I've got it here as a super cycle low. Sorry, a cycle low. Yeah, super cycle low. Um, we had that first bounce up and then a consolidation into this too low. So from beyond that, all the other patterns are grinding up. We know we're expecting the 3rd wave to be the biggest. So the bearish people put this, what is labeled here as a lower wave, lower degree wave 1, um, was labeled as being the 3 because it was slightly higher than this original 1. Then we consolidated down to here. And then the bears have been calling the top of the market as soon as we've broken above what that level was there, which was the 35,757 on the Dow. We've been finding loads and loads of ways to try and still make that valid. Now remember, we talked about the length of the wave, so you can easily just look at the percentage moves to give you a clue. We had a 1% move on the first wave. Now, if that was a valid wave 3 at 14%, that meant that the 5th wave had to be below 14%. So as soon as it can't move it. I'll leave that as is. As soon as it got above 14%, and the way I'd put it in there was 19, 14% was somewhere down here, 36,800, 37,000. So that made the whole thing invalid. So at that point, if we go back to up here, if all of a sudden you've got the waves looking funny and that 3rd wave is no longer the longest, it means that you're in some form of here, so you can get a lot of extension before you even get to your 3rd wave, and then you'll have another sell-off, and ultimately your 5th wave will be another high. So within the structure that I've had as a setup, we've been grinding up to that 3rd wave high, which meant that the pullback we saw in April was always gonna be a wave 4. Why my whole idea, remember at start the end of March into April, 3, 4, 5 heaven, you're gonna have a 3 top, and then you should be expecting a sell-off. You either played it or you're using it as a way to buy, and then you knew that we were gonna have a new all-time high to set that construction. The Dow had led the index down, so you were expecting it to have some form of lead to the upside, and so it kind of proved. But this is classic wave counting, and the bears should know better. They were being a little bit naughty. So what's happened since? They've continued to try and keep in what I've got as a 3 as being the top of the market and expecting to have this mega deep sell-off. This all again falls back to if you look at things in longer time frames, which you should I suggest you should always do just to get a feel for where trends are in the markets. There's been a massive argument since the COVID situation, which if we look at that on this one. So into COVID, The people of a bearish persuasion suggested that that was the end of a grand super cycle, a big move up over all the decade. And normally you'd expect something of that degree to be a very protracted sideways move, or it would be deep in price. So the fact that we fell 40%, even though it was only in a couple of months and then recovered, that is a kind of valid structure to say that you put in a second low. So ever since then, the bulls think that we're at the start, a very early situation of the next big wave up. And if you know that I talk about third wave is always the biggest, then that puts us in the very start of a third wave, looking for mega highs, and that's seemingly how we're playing out. Now, if you're of the bearish persuasion, you had the super cycle ending at the top of the market in 22, end of 21, 22. So after that, you're expecting a very deep three-wave move, and we did get that big move down, the 22%, which the bears had as an A move down. After that, they're expecting a B, which may even go to a new high. That's the expanded flat idea, and then to come off. Ever since then, the size of the move has been massive, even though they've kept going and trying to say that it could be an expanded flat, but they are kind of running out of room. We kept doing it. So as you can see, we're still making our way towards what would be a lower scale. Uh, that's the primary wave cycle, and we're only at the start of a cycle. So the super cycle is made up of um, 5 cycle waves. 5, sorry, 5 super. This is a grand super cycle. So you'd have 5 super cycle, and here the red ones are just the cycle. So we're talking about should be at the start generally of a long time, multi-decade high. There's gonna be big pullbacks, as you can see along the way, consolidations, but generally, until we actually have a proper crash that goes beyond what we're expecting, it looks like the bears are forlorn. This is why I'm kinda getting excited, because it's getting to the stage where just listening to how the bears are set up, it's right on the cusp of being, if they're true to what they represent, then they're running out of runway. And this is a similar way of looking at the current setup from, I'd not touched this at all until today for 2 months. So the waves are a degree lower than where we possibly are, but it just shows you how it's been building up. So we're still playing out the 3, 4, 5 scenario, even though we've just gone to a new high. Within this, we're expecting movements up, back, consolidations, but we've still got to put in a set of 3, 4, 5s. This is why it was always 3, 4, 5 heaven, because you're forever gonna be putting in a 4, an E5, and, this is a bit like the gold setup, how you once the nest breaks up, you're concertinaing to the top. So hence, there is, even though we're consolidating the break to new all-time highs, I think once we have this current pullback, which could take us, if it catches fire, it could go back to 38,000-ish maximum, I think. And then we're expecting, actually, sorry, I'll look at that again. I'm only expecting a short pullback. This is if the total of the wave 4, if you have an extending middle wave like we suggested, the 1 and the 5 should be the same height. So here, I'm kind of forecasting where we could be going for the minor wave 3. So that is another 13% move like we had down here. Gets us up here to 42,000, then a correction back to 38,000, and ultimately up to 45,000, which is what I mentioned yesterday. So the current 5-wave setup could still get us to 45,000 on the Dow. Sounds ridiculous, but we are in this, as I presented yesterday, reminded you what we said at the start of the week. The whole seasonality of May to August, particularly June to August in the US, is massively bullish in presidential 4th years. So be very careful about when these things are consolidating and getting carried away with the downside. It's every chance you get whipsawed. Oh, yeah, is the 1 hour I want to show you. So again, very much a similar case with the current setup, why we're close to having one more breakout and then consolidation. Again, we had a 1 move up, 2-wave consolidation, and then this current breakout has been and extending 5 waves. The first wave up was 3.28%, the second one 2.15. Again, unless we're gonna go higher very, very quickly, we haven't got a lot of room left before we start consolidating, but that is still another move up above 40,000, maybe to 40,100, and then we put in a little consolidation back to 39 kind of thousand. And the issue for the Dow is that it doesn't have NVIDIA in it, so that'll be very much a case of following the other indices probably. But here we are, yeah, it's presented here, grinding up once the consolidation is in. So is that kind of clear for a way of looking at how you look at the Elliott waves within the structure for setup? Because that's where it does get quite powerful that the rules start ruling out things. There's a bit of backward predicting, but it also gives you the chance of looking forward at what probably can't happen. Again, if this were to go much higher than 2.15%, then it means that we've got another subdivision going on at an even lower fractal level. So you'd redraw that, and that would get us probably to a higher red wave one. That is very interesting. We need to see how we react to the short term. So keep an eye on the latest upload on that index. So any questions on that at all? It certainly shows you where the big arguments are with the bulls and the bears, and that they are. Let's just go back to that original setup we've had for weeks, the chart we've been looking at. So remember I'd said we were looking for that one more tick, which we got when we went above the 50-day moving average, and then we've had this move up consolidation, the current breakout level. We were looking for 1.618. We have taken it to that, which I said, if that happens, you're in an impulsive scenario. So the bears are trying to take on what's a fifth wave, which should have 5 legs into it, and we're trying to tell you that the third wave is potentially the top. Now, some of them have conceded that we might be doing 5 waves, and once this fifth wave is in, then it all goes to poo. But we've said, I've shown you quite clearly why, particularly on the Dow, this is an extending fifth wave. Because it's extending, that has left us in with the larger scale 4 to come, and obviously the fifth wave to come before we get to anything like a reasonable top. Once that cycle wave 1 is in, then we can have a decent consolidation, but that is probably we're probably looking into Q3. That sits perfectly with the nervousness going into the presidential election, get the seasonality out of the way. So lots of things, again, it's mapped out for you from the waves in advance, and it possibly fits with the narrative. We just need to delve as we go along into where the short-term setup is. So that's a kind of way, and I look at all the markets in this as a basic setup, and then you'll delve into other indicators to try and work out when you should be entering, looking for confluences from that point of view. But this is where I get my basic overall setup from. Right, so where were we on the sheet? I remember, I don't know if anybody actually read, Vivi started reading him yesterday, John Authors. Again, another good piece today, talking about how crazy the Dow is, ironically. He always seems to talk about whatever I'm gonna talk about in a different way. And he's quite right, it's a ridiculous index, and it's morphed over the years into one where they manipulate it. Keep putting in every time they see a stock that's in there is about to do anything that might change its price, and they find a way of taking it out and replacing it with something else. It's become a very upwardly biased, log normal biased index because it's based on prices, not market cap. It's not that's hence gives it a bad quality. What they're totally scared of is when people do a stock split. So I don't know if you ever looked at buying stocks, but when you see them in pennies or in pounds, you're okay. But once it starts to get to £10 or thousands of pence or cents, people start to get nervous, and because the higher the prices, the fewer shares you get. People psychologically tend to not like that. So to encourage volume and activity in their shares, what happens the higher the share price goes is an incentive to change the dynamic. So it doesn't change the value of the company, but it changes the number of shares in issue and the price. But if that happens to a stock that's in the Dow, then that automatically causes problems. And then Apple have done that before. So Apple, from overnight having let's just say they had a 10% impact on whatever their price did. The once they did a stock split, it suddenly became 1 or 2% impact. So that would not make the constrictors of the Dow very happy, and they've always kicked out stocks that start doing stock splits. So you don't, and then unfortunately, you tend to lock in some of the pullbacks. That's something that authors talked about today, and it is quite true. So it's not that, it's a long-term interesting index, and it's good for the, I think, sentiment of how people trade it. It's not that bad for actually trading in our systems in in the simulated world, but in the real world, people hate the construction of it, and quite rightly. It doesn't have any real resemblance of real performance. But equally, once you go to a market cap weighted and you get super outperformance like the Mag 7, it starts getting tainted and manipulated the other way. But at least that is down to real market caps, and you won't be getting kicked out of the index anytime soon. So yeah, that's very interesting. So data-wise, anybody got any questions on the data this week and why things have changed? So it was always going to be set up as a strange one, wasn't it, with PPI coming in first? And that did kind of help the mood, I think, after the crazy delivery of how it came. Let's just have a recall on that. Right. I'm just going to flip over to that chart. So if you remember going into PPI, and this is why I said at the time, see how these are all in red on the chart that I have up. Most diaries should do this, but that means they were all revised down. As we know, they got revised down 3.3%. So you can either throw those back in or just think, 2.1 was actually 2.4, and it came at 2.4. So net, you didn't really have any move. Yet on the day, it looked quite a move in the core, and PPI down 0.1% last, and then up spot 5, but obviously that was going down spot 3. So if you add the spot 3 back in, you get back to consensus at spot 2, which is why everyone panicked on the headlines, and then professionals steamed in and went, "Hold on, that's revision," and net, there's no real change. Vivi, glad to hear that. He's very good, isn't he? Always was. He's in the FT for a long time. He moved to Bloomberg. Normally, he'll be on or about the things that are being talked in the hedge fund world. So he'll always have something quite up to date to talk about and look at. So that, remember, that's why I say to you going in, particularly if your diary doesn't change the colours, you put it in straight away, you're not going to notice that unless you go straight to the data. Like I said, go into the actual releases on the BLS website. They normally mention the revision preamble. So anyway, that we got through that, and we got away with it, and everyone started to say, maybe not as bad as we thought. We got the kicker with CPI, more or less bang in line. There was no revisions. CPI in the year, sorry, not the Swedish one. Yeah, here, apart from headline CPI being slightly lower, everything was bang in line. And we got so that was, when we talked about it, all the inflation data from last week that had gone in was right at the extreme of nearly having rate hikes. The whole point of just being in line was coming back from the extreme more to the middle. So it's not necessarily whether you're gonna get a rate cut, it was more the fact you weren't gonna get a rate hike that has been driving everything. And then we go to the CME website, the old favorite. That's become quite interesting. So again, it's useful. Where are the probabilities? Amazingly, June somehow has nearly 10% of people expecting a rate cut. in June. I think that is slightly optimistic to say the least. You can see, a week ago, totally written off. So it priced it in slightly. July, well, a lot more interesting. You've got people. This is what I was starting to talk about during the week. If data is starting to fall off, hold on. Thank you, Edward. Nakash Kuja, I want back my account and pay out. Don't behave like TFT or other platforms. Behave on cheap. Um, Nakash, this is just analysis. If you want to go on to the public chat, then somebody might be able to help you with that, but it's not really for today. Um, so yeah, what I said was, and this has happened historically, if the data does start rolling over too much, then the Fed will start having to think about 50 basis point move. That's simply there, even for July, which is way out of context. It's starting to price in a little bit of the 50 bips, but it's, nearly 30% expecting a cut in July. Again, we have to see some more bad data in the meantime for that to happen. September has become the very interesting one. Look, 50% is still there, but we're beginning to increase the percentage, expecting the bigger cuts. Yeah, 66%, 2-1 on that we're going to have a rate cut now in September. November, again, it's all solidified. We haven't had any pushback. So we are back to 1 or 2 by November. And December, we're all still slightly increasing on the week, just about right for the data we've had. That sort of sits with the talking heads, Williams going, fantastic data, but it's not going to move it just yet. We need a little bit more. Now, I thought overnight of the people that spoke and the one that's normally difficult, Bostic. It's not going to work, Nakash. Can you please desist from putting those comments there? Please go to public chat. Somebody will help you. Yeah, Bostic was saying that he's now noticed finally that the shelter part of CPI is slowing down. We know that there's still some big beats to come from that. He's now talking about that being a one, not, it's not a trend yet, but because of the size of impact that shelter has in inflation, it's good to see that some of the more hawkish people are actually acknowledging it's there. And Barkin, again, overnight said retail sales was having a big impact. Sorry, he was expecting the big impact is coming from services causing inflation, but that retail sales coming in soft, that potentially is for them to question how hot the market really is. So that's encouraging. It's not all one way, and even the hawks are reacting in the proper way about the data rather than just being dyed in the wool. So encouraging. We're not expecting, with the growth situation we've got, any rate cuts. I think we're okay without them, but that would be a proper kicker for probably when we get the consolidation towards the end of this quarter. Yeah, I'd like to see the real questions, Nakash. Can you stop putting comments on my chat, please? I need to hear from people who want to talk about market analysis. So hopefully, CME tool, that's clear. The rate cycle is still there in the background, but it's more of a support than the driver. Right, while we're over there, we'll go to the Atlanta Fed. That is interesting. Right, here we go. So you can go to the Atlanta Fed website, and you get a link into this. Damn. So I clicked on the wrong one. Apologies. Right, yeah. So here you go. So You go to Atlanta Fed and it's on their page, et cetera, et cetera. Well, you can see here, this is a time sequential update from their measure, how they would create GDP, and it shows you by. So remember I talked about the other day, the AD equals C plus I plus G plus X minus M, et cetera. This is it in real time being constructed, and then you see the piece of data, and then they go through and put it through the sausage machine and tell you. So the PCE, which is what the Fed follows, we've got that producer price index because it was in line, so we stayed where the 3.9 was. The whole read through from retail sales and consumer price index CPI, that's the kind of effect that you get. So we had this jump from last week through the data to 4.2 for GDP. That brought it back to 3.8, but the biggie for the week was the 3.9 PCE dropping back to 3.2. That in itself is something and a reason why they should then start thinking, oh, they're going to start talking about rate cuts again. That is the inflation measure that the Fed watches. It's back in line from all this breakout stuff. And again, yesterday we had the import price jump that was as unexpected, so that then shifted us back up by another 0.2. So this is a great one from the fundamental side, just being able to get on top exactly what the reads are, for the inflation element, the investment side, the I, the G, that's the X minus M, and PCE is a combination of consumer expenditures and the prices within that. So really, really, really powerful stuff. The Atlanta Fed are quite on top of things. They're the ones that also have an index on rents that have been falling for the last 8 or 9 months, which is why we think that CPI is eventually going to fall. Blah, blah, blah. Shame we've got this guy ruining everything on the chat, but there you go. So everyone okay with that? Any questions? And while I'm at that, did anybody out there have any idea that the CPI had been released 30 minutes early? Apparently, there's an investigation going on that it was released. That's another reason, again, to go on to the bls.gov website and just click on what the CPI is anytime from 1 o'clock by the sound of it. But whoever they released it to, and the very trusting market, nobody had actually clicked on it by the look of it because it didn't have any movement at all. In fact, a lot of the movement in the indices was a spook the other way, going in, if I remember rightly. So, yeah, something to keep an eye on, but I don't really remember hearing anybody say that it was released early on the day. NCME tool, Atlanta. Oil demand, did you see my comments yesterday on the tweets that we put out? Where did we put that on? Must have been Wednesday, I think. Yeah, on Wednesday. So you had the mnemonic fest of the week, EIA, IEA. The IEA is the European-based one, and they put their outlook for the year, where they downgraded their total oil. It is ridiculous, isn't it, Michelle? Quite right. And oh, Hammy's back. Where have you been? Where have you been, young man? Yeah, it's incredible, and they've messed up the last month on CPI. There was a leaked email as well. So completely bonkers how that could be happening. Somebody must have beef with the stats office or something, but I'm sure it'll get sorted out. So yeah, if you read that tweet or not, it's just the reason why oil isn't really breaking out on the OPEC cuts. We've been talking about it for weeks because America have become number one in pumping. and the IEA was saying that they expect it to jump next year, but they showed you their numbers for the second half of the year. OPEC supplying 42 million, which is 700 barrels above what they have been doing, and they've kept those voluntary cuts in place. So there should be a shortfall of 840, but the growth rate for ex-OPEC, rest of the world, is for 102.7 million barrels a day by the end of the year, which equates to an increase of 580,000 a day. So that's more or less offsetting all those cuts from OPEC. So that's what's going on, and probably why, when we look at it again in a minute, we're stuck going sideways. Um, I'll run through the indices at the moment. In a moment, we just went over the Dow situation where it is going. We're pointing out why it's going to go higher and higher, but that includes consolidations. We're very close to the consolidation. In the near term, we're probably one more breakout above current all-time highs, and then we should consolidate a little bit. But that's a fourth wave consolidation within what's probably a high degree third wave in most of them. So we'll have a look at that in a minute. Everybody's turning up now. Vivek's here. I don't know how to say that. Al Hadithar, is it? Al Hadithar. Well, thanks for the question. We'll look at it in a minute. Yeah, but it's weird, isn't it? I mean, you can look at revisions as manipulation. It's just bad ways of constructing the early releases. Certainly not helpful. At DXY, we'll have a look at that. Right. Let's just double check there's nothing else on the thing. Oil demand. Yeah, we'll look at the charts. So as I showed earlier, DXY, we started the week suggesting we'd hit a low for one more turn back before we carry on going. And we did put in very much a 5-wave move down. If you look at it, we had the one consolidation. This is where we said we'd expect a bigger move down, small consolidation, the 5th wave of that. I just wasn't sure whether we'd get another little play around here, but as it is, we're putting in what looks like, and we've already we're quite close to it, a 1-for-1. Still think we should grind up to 105, and that probably sits with a bit of churning around here, allowing the markets to get to an all-time high, have a consolidation, and then once this starts selling off, wherever it happens to be in here, once we can identify the top of this move up, that should allow the indices to rally again. At the moment, we are definitely in the grind for the blue wave 2 here. I understand why my files are so heavy. Yeah, lots of stuff. Um, yeah, well, that's Michelle and Edward. Yeah, definitely. I mean, obviously, I gave you a quick preamble earlier. You can go to any kind of basic Elliott wave idea just to give you the setup and thoughts. You can get hold of a copy from most of the Elliott wave sites of the original thesis, the ideas. You can have a little read of that. Come and ask me any questions as you go along, because there's a lot of confusion within that, but it all comes back to the fractal nature of it, waves within waves. So the EU, as a read through from that dollar's doing the similar thing. I haven't actually changed. The idea was I thought that we'd go up, we'd consolidate a little bit earlier, that the pattern is right. It's just where the top was. As we have put in slightly high since then, again, we've ground on EU, we've ground out on equal legs already. So that 2 is really there. 1, we had That's why. So that 5 has gone up to there, and wherever my 1 has disappeared to, I don't know. It's the very nature of that, because it's a 1 with a consolidation 3 wave at the moment, that could, as we've said before, could end up putting in a false breakout and another 3 down, so the overall would still be a 3 swing, but it'd be in 7 sub-swings before we go higher. But the premise is that we are gonna go higher in EU eventually once we've put in this wave 2. At the moment, I've moved that there to keep an eye. We should get a rally of some sorts. Every time you have a 3 wave as a consolidation, there should be a bounce back, even if it's just another 3 waves before it goes again, or it's the start of a new 5 wave to break out. So it's very much worth having. It's worth a play having a breakout on EU with the equal legs as a stop loss while you watch it. So it's the same premise on what I've got set up for the dollar. It's all, so much of the weight of the dollar is EU that it obviously has a massive correlation. We'll look at gold in a minute, Mr. Anonymous. Um, yeah, remember, it's not always who's that? Vivek's not always a one for one on that whole dynamic of the EU. We kind of feel that the EU did have 4 cuts in it, but there's already chatter because they don't want to get too. Remember, we talked about this last week. They don't want to get too divergent from the US. Schnabel, either this morning or overnight, has again said June they'll do something, but July sequential cuts not likely to happen. In the meantime, we've got this flip flop back towards the US maybe being slightly weaker. And as I mentioned today, something I want to keep reintroducing and will possibly be why the market rallies. The markets, the stock markets particularly, are a 6-month in advance discounting mechanism. What that means is if we're not gonna get these Fed moves this year, and if inflation isn't necessarily reigniting and we're just waiting for continued unwind, the disinflation does seem to still be around, we're flatlining rather than bouncing up, then very soon next year, those rates will start to look very tight like they were supposedly gonna be for this year. So all the arguments for 6 rate cuts again in the States will start coming to the fore and not sounding stupid. The argument has always been, "Oh, we're not going this year, it's gonna be 2." Everyone's forgetting that there's a rate cycle carries on next year. That can very quickly catch up, in which case that whole argument for the EU, which is probably 4, and the US 4 but delayed, kind of loses its bias towards Europe. So I can see why that is gonna have lessening impact going forward. So to answer your question, yes, it can, but I think there are other factors at work at the moment. While the data is starting to drift in the States, it's making it just bringing it back into view that the US might not necessarily have to wait that long. You got into Aussie dollar. Edward got into Aussie dollar, US dollar shorts just 20 minutes ago. Oh, sure. In the short term, while that dollar is playing out like that, just be careful. I remember what we haven't talked about was the Chinese data overnight, and that was massive on their new 5-year plan, industrial production to bounce back. That was on plan, and that is really strong for the commodity outlook. So be careful going against the commodity currencies too much. But obviously, their consumer side, we thought the imports was coming through on hope for the domestic economy. Looks pretty much like it is imports of inputs for industrial production. That isn't as helpful as it was. So the consumer isn't doing anything because this overhang of the housing thing, They changed their rules for the mortgage market today, and they did a 42 billion fund creation to try and buy up on empty houses, which was a classic from 20 years ago. They were doing this, but hopefully that'll shore things up in the short term. But keep an eye on it. Um, what is my take on the Japanese yen? I mean, there's some rumours that they possibly went again during the CPI situation. I talked about data that I've seen. People have been talking about 152 puts and 160 calls being heavily traded this week. That could easily be what they call a reversal. Like, so people may have been selling the calls to buy the puts, but haven't actually gone in and looked at the volatility data on that. But it's good to see that people are actually playing both sides of it somehow. They may even have a straddle on. We said if there is any chance, the data's not necessarily helpful in the short term at the moment in Japan, but as soon as they can, in combination with the US, just getting rid of the rate hike side, that was obviously helpful on the week. We have started to see a little bit of action. I'm just slightly concerned that while it's all words and action, that we're still in a potentially grinding up situation. We need to see that 152 barrier that is probably sat there as support now, which was the original line in the sand. We need to take that out really and hold it. Otherwise, we're pretty much in a nesting scenario. It may well be 160 calls are what are being bought for upside. Japan haven't really got the room to move, although they should if they've got any designs on the market believing them. I think I mentioned it to everyone that the currency offset was beginning to see BlackRock see people not invest on the equity side. Inflows net have still been positive into Japan, but people really want this sorting out now. The currency, they want a floor putting under it so that they can start investing and not have to waste money putting the hedge on. So it's a mixed picture at the moment. Obviously, they intervened in here. They intervened in here when the CPI came out, and they obviously had a go last week in there as well when there's some more soft commentary from Powell, et cetera. So they're taking every advantage of dollar weakness to have a go, but whenever they're not buying, it's pinging back. So just got to be careful. They spent $60 billion is the market estimate. Remember I said it cost them $100 billion to put rates up by 5%. Well, that'd be on an annual basis, et cetera, but it's not as extreme as it sounds if they're gonna be spending 200 or 300 billion trying to defend it when they could do something that would make the thing drop. I mean, if they put rates up aggressively, you'd be down here into the 130s. Why I say they need to grow a pair. We'll see. So potentially 4 from the ECB, Vivek, is the idea, and 2 from Fed by the end of the year. I think that is probably consensus, I think. And obviously, it's whether we get something in September or not. So any other questions on UJ? Just to show you, I think that the issue with Europe is that they just need to keep the momentum going, and they don't wanna have any kind of tight policy. So Europe, UK will see a big drop in inflation. There's potential for it after the wage thing's out of the way. And they are coming off a low bounce in activity in Europe. So they really do need to keep momentum going or it will slip very quickly. So I think they will look to support it. As soon as there's no inflation threat, any slowdown or flatline in the economic data, and they'll cut just to boost it. And again, with the Fed, the inflation is hopefully beginning to roll, and we've seen cracks in the employment side, and the data side is mixed. So again, and they've already said explicitly that if the data falls apart, they will risk inflation. So just keep that in mind whenever you're listening to talking head rhetoric, 'cause they will change on the spin of a coin, the drop of a hat, blah, blah. So the VIX had a bounce, didn't it, at the start of the week, just to get away from that, what was deemed to be an oversold level. We've gone back straight back down to it again on the all-time high break. This is what we said. It's highly likely that we have a lot of choppiness here. Isn't it's in it's not really a turning point whatsoever. It's not in the greed. We're probably still on the cusp of fear and greed. It's not overbought, blah, blah, blah. So that could easily come down here. I wouldn't get really worried about the VIX until it hits 10. The UK, that's Jim, more or less what we said. We'd have the breakout, try and consolidate, and there's one more high in that before. And this is gonna be a repeated pattern through my charts for the moment because they're all set up in a very similar way. That we're expecting further all-time highs, but not masses just yet. We do need a consolidation. It's gonna be interesting, as I've been saying, whether this comes before or after NVIDIA, and there's every chance that it looks like we may travel and arrive into NVIDIA. NVIDIA may well not be as crazy bullish as last year when it jumped 30%. It might be that we get an in line. That's an excuse to just consolidate. The outlook will probably be fine. People just use it as, the wheels haven't fallen off, not a negative, and we push on. That's possibly what the charts are telling us. Again, we looked at the Dow earlier. So we're in the midst of still doing this 5-wave grind. I think we've done a 1, 2, 3, so I'm expecting consolidation short term is where we are here. We're probably one more blip up from a 5th wave of the 3rd um, minute wave here. That should have a 4th minute wave before a final one that puts in. That's either a 1 or 3. I haven't decided. I need to decide where we are overall, but it looks, I think we're in a big grind higher there, so we're expecting a pullback. I said earlier, no NVIDIA to this one. Dow's got every chance not to get that affected because it doesn't have that component within it. The S&P is very much the same. We're in a very low volume situation. It'd be interesting if we get the bears suddenly getting excited that, as I said earlier, they've recalibrated so that they're expecting this new breakout to be this 5th wave here, and hence, for them, that grand super cycle top. For us, it's just one of the early intermediate waves of a big advance that we expect to carry on. I'm expecting bull market, bear markets, if you know what I mean, consolidations within a bull market, whereas the big technical bears out there are calling for the end of a multi-decade, almost centuries move, and that they're expecting a deep overall pullback of 50-60% of the whole market. I think that's not there yet. Has the potential if we do get that super dollar collapse, but that's equally likely to be something else from a much higher level, then that pullback won't look as severe. I think we've still got to get the overall supercharged growth breakout for that to happen. Anyway, in the short term, the consolidation pattern, and again, this does have the larger cap stocks involved, so we may have larger impacts. Again, this support zone on the volume here around where we've already got priced in on a 38 fib for the 4th wave, all sits on the volume support. I expect that to hold. So again, when you're doing Elliott wave and you're looking for a 4th wave, they tend to be in the region of lower scale 4th wave. So you've got the 4th wave we haven't put in yet, and also the 4th wave of the minor 3rd up. So this gives you a target range for where the 4th wave will go. All becomes quite powerful, and then you can look at the fib relationships within it. Gives you a nice path within it, and then you can look for your even shorter time frame entries using other things. Hi, Cyrox. Good question. Are the interest rate cuts already priced in? Potentially, but, we've got such a flip-flop on it, and depending on who you listen to. Remember, we had the setup at the preview, the start of the week. We only had a slight change in that. It's very easy to paint, fundamental bearish picture if you want to, but I think you're at the situation now where, and I explained what it is. It used to be called the Greenspan put, then the Bernanke put. They only call it the Fed put now. Obviously, Powell hasn't earned his stripes yet in the market community. Eventually, it'll be his kind of put when he does it. But that's now very much it's the plunge protection team. It's the Fed. It's the Fed put. They'll put that into action if growth slows down. At the moment, growth is there. So the rate cuts are the icing on the cake. Shown the CME tool is pricing a couple of cuts in. Similar. I don't pay for them. There are similar um, things on the other indices, and you can also price it in from looking at where break-evens are on bonds around Europe and in the UK. You can probably find some commentary on what the expected rates are around the globe. So, they're on the verge of being priced in, is what I'd say, but I don't think they're actually needed for the bull case in indices. That's S&P. Nasdaq, remember, we moved the fifth wave to being a higher gradient than what we had in before. We're in that channel. So that can easily consolidate across to the lower side of the channel. That sits with where we were expecting that fourth wave to come in. I think we got short-term pullback within this wave, takes us to a lower trend channel, then we hit the fifth wave. Then the high degree primary wave 4 here comes before we get another breakout. Now this, again, it's all about the interpretation of where NVIDIA comes, because that is obviously gonna affect the Nasdaq. I think the worst case scenario on NVIDIA is interpreted as some kind of in line with the trend that we've seen from uh, Amazon, Microsoft idea post Meta, that everything is actually all right. Their delivery will be strong, but if anything, I think this is probably the reason that we do go very quickly to new highs, to start this whole new. Remember, we've had 3, 4, 5 heaven with the small degree, and I said it. The reason it's 3, 4, 5 heaven is because we keep seeing a repeat of that. It means that you do get an opportunity to have a trading sell, but you have it in your mind that it's not the big daddy boy sell-off that the bears are talking about. These are expected sell-offs in a grind higher. Yeah, NVIDIA, it's strange, isn't it, with all the timing? I think it's because of the annual um, situation we had last year. Remember, it had got in a bit of a mess, and then upped its guidance by 50% on this update a year ago. NVIDIA moved such a long way, so it's got very. The reason why we might be getting consolidation within it and around it is because it's year-on-year comparison. That's how a lot of analysts will look at it. May look quite confused, but I still think they'll have something to say about overall growth rates, and that should get things going again. But, we've had a big move up, and we take note of that, but it is the crucial thing here is it's moves up within the bull market and a grinding higher 3, 4, 5 heaven situation. It isn't a topping out wave 5 of a 5 of a 5 of a 5, which the bears have been saying. That I know that some of the more honest, astute ones are really on the verge of converting to this, and they've already admitted that if they converted, there'd be much higher highs. So what I talked about yesterday is that the bears have thrown the towel in to say that this is now 3, 4, 5, and trying to hold on to this being the end of their idea. But the real capitulation that I'm talking about hasn't happened yet. That is when the bears admit that they're actually in a bull market and not in their all-time setup for the end of the world. So that is what is going to drive us into the June, August, I reckon. Stairway to heaven, baby. Love it. Like it. Um, he was asking gold. What about gold? What about gold? What about it? Right. just as we flying past, so NVIDIA hasn't quite put in the all-time high yet, interestingly. So it's had a consolidation. That looks like one of these extending waves we talked about at the moment. This middle one here is about to get so if this was a 1 consolidation, 3, 4, 5, that fifth wave is about to be bigger than the third. That tells you pretty much that is a whoops, that's likely to be a sub 1, 2, 3, 4, 5. So you've got this consolidation in the midst of going higher. When that fifth wave comes in up here, that is only at the top of the third wave, a consolidation, and it goes again. So looks like I'm trying to convince everybody that there's only one way. There's lots of things that can happen, but the way that the waves are set up is sort of suggesting before you even get the news of how it's gonna play out. That is kind of powerful. I mean, if you have a bearish disposition, then just like we said on the indices this week, put on a sell with the all-time high as your stop loss. You may get you may capture what is a consolidation at the moment before it goes higher. There's ways of trading it in and around the event, but I think just be careful. If we do get an all-time high in NVIDIA, I don't think it is necessarily right, that's the end of all that forevermore. It'll be a new time high because of the guidance. Right, gold, obviously lots going on, and that is really interesting what's gone on there. Right. So I haven't looked at that since you put it on, 'cause I was saying the situation we'd had since that high from Thursday was that we'd put in a valid three-wave consolidation. We were looking, which is a 23.6 fib, and I said that is quite powerful because it's where those bears got eaten, swallowed up around the CPI situation. Equally, we had this big support, fair value gap, order block, however you wanna call it, down here, that possibly needs to get challenged, and that's the 38 fib, and the reason why I've got this 23, 50, 70 potential range. But this is interesting that we're challenging and have just put in a new top now. In wave theory, you can have a new top as part of a consolidation. That's the expanded flat thing. So I'm not gonna give up on it just yet, but from everything I've just said, this is starting to look impulsive with a subdividing third wave here. So we could well have had a very shallow. We did talk about gold needing shallow waves or having shallow waves in its move up all the time. Dangerous here. I'm not gonna commit either way at the moment because it could equally fall. The bias is for a breakout, but I'm not gonna commit until I see a proper breakout here that holds, because it is still valid that we could be doing this, what should be a three-wave consolidation. Ultimately, I'd love to see this 2370 retested. A lot of people would like that retest, however you look at it, for real expectation of powerful breakout. So very tricky at the moment. What is encouraging is here, the one thing that we haven't had, so we're actually now getting volume, momentum breakout back into positive on a pickup in volume, no real data in the way, it's a quiet day, et cetera. So if the bulls wanted to take over, they easily could. If we've said, as we've been saying, if somebody has got physical supply problems, then that could easily be the start of the proper breakout to that 24, where's the all-time high? 24.31 is first proper stop to see where there is a double top over here, isn't there? We talked about yesterday, but I don't think that is a genuine uh, situation to hold us back. I think if we move in here, we're definitely gonna challenge that all-time high. 25.50 is the idea for the top of that channel. That is for the third wave, that is right up here. The one spot 618 of the minor wave is 25.55. So we should be in. Remember, if we're here, the minute wave 4, we've got minute wave 5 left, which is what we've started, and we're in the early, smaller degree waves of that on the way up. And the ultimate fifth one of these takes us to that red 3, which is the 25.55. Just very wary of getting you to buy this breakout here and seeing it then retest, but massively encourage you to trade anything that comes back into this range. So I think then we've got a proper valid 3 wave in. The only problem we have is if we're going into a sideways consolidation for a couple of weeks, then this is gonna very much do what we've had over here, where you get the potential for a 1, 2, 3 wave, a consolidator, another 1, 2, 3 wave, still in the same kind of zone, same kind of lows, but it's gonna be a range trader. Obviously, traders can make money at ranges, and then we break out. So the overall top breakout idea is there. It's just when we get the breakout. At the moment, that's encouraging, but we really wanna see this break above the red line we've got here. I wanna see that really put in a proper extending third wave so that we then buy it on any kind of pullback from that breakout is when you buy it. Yep, so gold has still stayed quite positive, hasn't it? The CFTC data is very helpful. Retail, I think if you looked in the others, if you actually go onto the CFTC website, I think you'll start to see retail gold shorts, which again is normally a sign that they've got the trend wrong. The last that was, last Friday, that kind of top. So they've been selling, going short into here, getting squeezed up. They're probably laughing all into this sell off at the start of the week, and then they probably stayed short and got squeezed, which is potentially why there's a lot of short closing going on. But yeah, no, I think the commitment of trader data is interesting because um, there are some big shorts in COMEX, but they have a way of making themselves not look short by playing calendar spreads. I've talked about this on previous weeks. You can be long 1 month and short another in order to keep your overall commitment looking flat, but you actually got a short basis in there. And they do that to try and suppress the price. I was joking earlier, JP Morgan has been a big agent for the US Fed for a long time, so they're known to have a bit of a short. So be interesting to know how JP Morgan's mark to market has been over the year. So silver last week in the move up here really, and this move up here caught up with um, what do you call it? With the gold ratio, I think, whereas gold moved up 1% or 2%, the silver moved up 4 or 5, 6. So it's starting to catch up on that ratio, and I expect that to continue. Yeah, I'm just saying it's good to look at that. Really pleased that you are looking at CFTC data, and you can go and break it down on the CME website. Lots and lots of reports, and it breaks it down by user. So you'll see the professionals and then the speculators, which are the hedge funds, and then the other, which tends to be the retail. But I'd always advise you to look at as many different angles on supply and demand as you can. Gold is obviously complicated at the moment with all the delivery issues, and the same silver. Uh, so that is DXY1. I think that is probably subdividing. I think I'd like to see that get to the 1-for-1 level before we sell off properly. So but just be ready for a bit of choppiness in everything. Today and start of next week is gonna be choppy. Nikkei, again, I said at the start of the week, that is either in breakout or we're still doing the complicated sideways. As I said, there's a bit of mixed emotion going on with what the currency's doing, and the data's mixed. So everything suggests there's a consolidation going on, but if the US moves up, I think this will get dragged up behind it. Oil, spoke with Edward on the chat yesterday. This is getting annoying with the whole data situation. We need this to break back into 80, really, take out this top over here where the divergence was previously. All those of uh, all these peaks and troughs, and the peaks have been in line with what looks like a consolidating move. This was the one that caught us out because we thought it was breakout one, but it looks like it was really just a confusing consolidation. So yeah, we'd like to see something impulsive, the breakout of the high. Otherwise, this could easily turn into a little bit more of downside just to extend this too before we eventually go. I do think the bias will play out as demand in Europe and China probably surprises slightly. That might just be enough to get the thing going. But overall, that pattern we talked about for a long time, it's been a real grind higher. It's every time it starts to look impulsive, it gets leaned on. It may well be that we're just grinding up with that original sideways move. Still takes us into the high 80s by the time it finishes, but don't shoot me for when this thing goes sideways for a few months, et cetera. It's not it's gonna be difficult to time that one properly. The DAX pretty much sitting in with everything. So that feels like it actually topped out yesterday and has started its consolidation. It's been quite deep. Again, every chance that we're just halfway in that looks like equal legs coming for a 4. We've done half of it. We're just possibly going up here. We might fail at that 50-day moving average, put the double in, and then we're back in line with everyone else and break out. Silver, that's just a representation of how in the last week or so it's been a lot steeper with gold. That's why it's doing its catch up. Expect it reclaims a 30, probably has a consolidation, and then once we break up again, anything can happen. The fifth waves in commodities, remember, mentioned it before, are the ones that tend to extend. In silver, they really do tend to extend, and that one could get very silly. Anyone that wasn't watching earlier, that is the euro dollar. Looks like we've definitely done a one for one. That is either going to put in a connector, again, do a double, just as while the dollar is topping out that little bounce, or if we do start to reverse from here, then we've got a valid three wave in to continue that breakout. 110, I'd expect at some point on the euro dollar in the near term. We mentioned the FTSE, that's consolidating, should break out in the similar pattern. That is back impulsive. And again, for those that tried to go early, look, we put in a 1 and a consolidation, and then we've had a short breakout and a consolidation, and then a bigger wave 3. So that again tells you that you've had 1, 2. This can't be a third wave. Yeah, this has to be a part of an extending third wave. That's a subwave 1, a 2, a 3, a subwave 4, 5 into yesterday, probably. We're now putting in that consolidation, and we're gonna get a newer high. So again, these things subdivide and tell you that the inner workings are, and that could even be that's still that's a wave 3 there, a 4 and a 5 that make up the red 3. This is why you have to be careful and aware of it, but more and more when you get those divides, it tells you that you're gonna have pretty shallow set of shallow fourth waves that take you to a new high by the nature of the extension. And when you get um, an extending extensions within extensions, the first wave generally ends up mirroring the fifth wave. So keep an eye on that. Near the end now. So UJ, we've looked at that. You'll join pretty soon. We talked about that. Still think the danger is that the calls that are being bought at 160 are genuine upside rather than part of a reversal. They need to do something tangible, and they're getting helped by the dollar, blah, blah, blah. But sooner or later, you have to decide whether it's gonna cost them on an interest rate basis or whether they're gonna keep spunking money defending it. To be determined. And finally, again, the VIX, that's chopping around. I still think a fall down to 10 is the proper reversal, higher degree wave 4 consolidation. At the moment, we're still in grinding mode. I'd expect that to stay here, X any shock event. So that's more or less it from me. I hope you found bits of that useful. If there are any questions, either put them in my chat or reply here, and I'll try and catch up with them. We're back on Monday, when we've reviewed the whole week, and have a look at what's coming next week. Obviously, NVIDIA is gonna dominate a lot into midweek. Data-wise, it's a lot quieter, I believe. So, good luck with whatever you're trying today, and we'll catch up on Monday. Thanks again for taking part. Yep, everyone have a great weekend. Be safe out there and have fun. All about fun. Yeah, remember, everyone play Captain Sensible, happy talking. Send it to Jamie Dimon. Pleasure, everybody. Take care, and I'll speak to you next week.